So welcome back, everyone. As I just said, we are now going to continue with risk management in financial institutions, more generally here in banks. And this is a very interesting topic for me because in my research, I predominantly focus on risk management in finance, in financial institutions, in banks, in insurance companies, but also in industrial firms. And you might probably know that we also have actually two lectures at the bachelor's degree on risk management. One is by Professor Schumacher, the other one's by me. We have financial risk management, which usually takes place in the summer term. So I could spend a whole semester at least talking about risk management. And usually the point where I start is, in the summer term, is why do risk management at all? I will not go into detail here, but rest assured that research has given this a lot of thought, why firms should actually do risk management. This is not so obvious. The theoretical motivation actually is that you can just, as with capital structure, you can show that risk management in a perfect capital market setting doesn't make sense. It doesn't create value. Just like capital structure with the Modigliani-Miller theorem, risk management as well doesn't add value in such a setting on a perfect capital market. However, just like with the Modigliani-Miller theorem breaking down as soon as you include market frictions, the same is true here. If you include, for example, costs of financial distress, if you have managerial executive compensation that is linked to options, if you have taxation and so on, so any market imperfections, then yes, you can theoretically show that actually doing risk management does make sense. So that's the theoretical side of it. However, empirically, this is a tricky question. Does it make sense to do risk management? What are the effects of risk management? What is the benefit? Does it come at cost? Yes, it comes at cost. Problem is that it's always very difficult to disentangle this endogenous relation between risk and risk management. Why do you do risk management? Because you have risks. When do you have risks? Well, probably if you don't do risk management. So risk influences risk management influences the risk you take and the risk exposure you have. So this is very tricky empirically to test. I can only urge you, there has just been a paper published by Adriano Rampini, Viswanathan, and Guillaume Villemé. The first two authors are from Duke University in the Journal of Finance, and they study the effect of risk management in banks. And what they do is they look at an exogenous shock to risk. What they are looking at is the decrease in housing prices in the United States during the financial crisis. Because for many banks that had given out loans to customers, they had used houses as collaterals, and when the financial crisis hit, those houses literally became worthless. So the asset value of those houses decreased, and this was a shock, an exogenous shock to many banks to their asset side. So risk increased, and then they study whether some banks who did more or less risk management were able to decrease this exogenous increase in risk. And the paper is called Risk Management in Financial Institutions. Very interesting. So the question whether risk management does any good, that's still an open question. But empirically, you can also argue that every bank does risk management. Every financial institution engages in risk management. And I'll later talk a little bit about how and how risk management has evolved. So let's start with a simple prerequisite. We need to know what we are talking about when it comes to risk. What is risk? And this can actually turn into a philosophical question. What is risk? In this lecture, just like with any lecture here at our business department, it is usually financial losses. We are not talking about the risk that I lose my customer. It's not the risk that I might produce the wrong product. That would be considered strategic risk. And nothing risk management offers can help you counter this type of strategic risk. I always give you this example, I always give students this example, that you can be the sausage vendor on High Street. And if he decides to sell the wrong type of sausage, he will go out of business. That's his risk, but that's his entrepreneurial risk. That's his strategic risk. He has taken the wrong strategy. He has taken the wrong entrepreneurial idea how to pursue his business. That's nothing risk management is concerned about. Risk management is rather the danger that, for example, here in this lecture hall, the projector falls down and hits someone, and the university gets sued. The risk that this whole building burns down and we cannot continue our lectures. That's risk. If we were a business, this would amount to financial losses that we might incur, and then we have to do risk management. So risk is understood as the possibility of financial losses. Could also be the uncertainty about the occurrence of possible environmental conditions, and as a result, uncertainty concerning specific business goals. In the end, again, financial losses. The deviation of a parameter from its expected target value. Well, if this deviation again turns into financial losses, then risk management is concerned. If it doesn't, why do we care? If any model parameter deviates from a target and from an aim, why should we care if at the end of the day we don't have a financial loss caused by this? And in this class, again, like in any other class here, it's usually a random variable, and those are random negative deviations of financial variables, in many cases financial losses. What you need to know is, and need to remember, it always has to be stochastic, it has to be random. If it's not random, if it's deterministic, we don't care in risk management. It has to be included in business planning. It has to be included in accounting, but it doesn't has to be dealt with in risk management. So it has to be random, it has to be stochastic. It is usually a negative deviation, and I'll give you a couple of examples to show and highlight that yes, sometimes positive deviations are also an indication of risk. And financial, it's never about strategic risk or entrepreneurial risk. It's something different, for example, to maybe a marketing class. And ideally, it should be measurable. In many cases, we cannot measure risk, but we have to think about other ways how to deal with this. Now, let's turn to the question why we should concentrate on negative deviations. Well, that's what we do most of the time. However, this is a pretty good example to show you that actually positive deviations also matter sometimes. It's the fall of Barings Bank. Barings Bank used to be a very old, very prestigious investment bank in the UK. And it went bankrupt overnight in 1995. What happened? They had the usual, pretty much usual case of a rogue trader, a trader on their trading floor who kept two separate accounts, one for the profits and one for the losses. He hid the losses, and his superiors only noticed the high profits he was earning. So what do you do when you see someone is earning profit after profit? You promote him, you promote him, you promote him, and in the end he was chief derivatives trader in the Singapore branch. Then something happened. In this case, could you close the door, please? Thanks. In this case, it was the great Hanshin earthquake in Kobe and Osaka in Japan in '95. What happened is an earthquake hit Japan. Japan was struck by this pretty hard. It caused Asian markets to spiral down. And because of those Asian markets going down, this rogue trader, Nick Leeson was his name, he was no longer able to hide his losses. So what did he do? He packed his bag and fled the country. He was arrested at Frankfurt Airport and extradited to the UK, where he had to spend some time in prison. This single person caused a financial loss of $1.4 billion. The bank went bankrupt overnight, and you can see many things happen. An exogenous natural disaster, we'll come to that later on. That's actually what we call an operational risk, op risk. And a rogue trader, again, someone, an employee causing and doing something illegally, that's also operational risk. But we also have high profits. And those high profits should have caused some alarm with the superiors, because, well, if you have high profits on a regular basis, you are probably taking risks on very highly. So high risk taking leads to high profits. So where are the losses? Someone should have gotten suspicious there. Second case, Bernie Madoff. Bernie Madoff was the inventor of the largest Ponzi scheme in the United States. He caused losses of approximately $65 billion. Can someone explain what a Ponzi scheme is? It's also sometimes called an illegal pyramid scheme. What is an illegal pyramid or a Ponzi scheme? The etymology of that word is tricky. It is named after the first person who did this, and his name was Ponzi. Hmm?
Instead you take money from your clients.
Yes?
And you always try to receive more clients so that you can pay back your first client.
Yes.
But in the end, all the money gets destroyed.
More or less. You don't, if you're, for example, running a fund, you're not investing, you're not paying out interest on those investments in your fund, but you're using the new capital inflows to your fund to pay out old investors. So there's never really any investing going on, but you're simply paying out old investors with the money you've taken in from new investors. And this keeps on. And for this to work, the scheme has to grow. This is why in German we call this Schneeballsystem. The snowball has to become bigger and bigger, otherwise it'll stop. So this was Bernie Madoff's Ponzi scheme. And again, he defrauded investors, and this only and investors only noticed this when during the financial crisis everyone wanted out, and his Ponzi scheme was no longer growing. Statement of a whistleblower: the biggest tip-off of a fraud was that Madoff reported his fund was down only 3 months out of 87, whereas the S&P 500 was down 28 months during the same period. It's too good to be true, and this can be an indication of risk. So that's Bernie Madoff's case. How do we measure risk? You can see here an extract from Thomson Reuters data stream, the S&P 500 composite between 95 and 2015. And as you can see, pretty standard ups and downs of a major leading stock price index. How should we measure risk? Easiest thing to do is to use volatility. Now with the S&P 500, it's very simple to look at the volatility because you have a traded volatility index, the VIX, on the S&P 500, and this is the volatility index for the S&P 500. Not surprisingly, you have high volatility during the dot-com crisis in around September 11, and extremely high volatility during the financial crisis, and relatively calm periods between those two crises and since the financial crisis. And you can extract this very simply. Now I've taken the same data and inserted it into R, and here again you can see the price index. Now you can calculate some log returns, daily log returns based on the prices, and this gives you this chart for the log returns. You can again see the volatility during the financial crisis and the dot-com crisis. If you were to take the absolute returns, it would look like this. Again, gives you an indication for the volatility. If you calculate the daily volatility, this would give you this chart. Problem is, volatility in this case is a little bit tricky because volatility is time varying, as you can see. and you need some elaborate and quite, well, not so complicated, but you need models that are usually taught in an econometrics class to describe the time evolution behavior of this time series. Now, here I've just used a rolling window, I think of 100 days, and as you can see, one gets pretty much the same plot as for the VIX. So that's volatility, but you can also look at the log returns below the 5% quantile. Now here you can see those returns on which the S&P 500 had a daily return that was worse than its 5% quantile. I don't exactly know where the 5% quantile was. I would guess at minus 1.5, 1.8%. So you can only see those days and those returns that had a financial loss of worse than minus 1.8%. That's the 5% quantile. This is the 10% quantile, so not as dramatic. And those are the log returns above the 90% quantile, and again, above the 95% quantile. So what do I want to show you with this? It's one investment. It's just the S&P 500. And you can look at volatility, price changes, continuous log returns, returns below and above certain quantiles. There are numerous methods to calculate volatility. You can also look at different things. We'll come back to this later. And actually, you can spend a couple of lectures just talking about the measurement of risk and how to measure financial risk, but you get the idea. You can use volatility, you can use some quantile-based measures. We'll see those later on. So what then is risk management? Just like anything in business administration, management refers to the process of analyzing a problem, coming up with some strategies for solving this problem, performing one strategy and doing something, and then making sure that you can assess the efficiency of your strategy and then repeat this whole process. So if, for example, you have marketing management, it usually is you look at the problem, you want to sell products, you look at the different strategies you have, do advertising, do no advertising, do radio, do TV advertising, and so on. Then you decide on the best strategy, you do it, and then you assess the efficiency. Was it the best strategy, or do you have to change something? The same here with risk management. It's the sum of all measures for identifying, measuring, managing, and controlling risk in a company. Doesn't have to be a financial institution, can also be an industrial firm. And actually, the literature is full with studies on industrial firms and risk management in industrial firms. Why? Because the financial industry is heavily regulated and it's supervised. And if you want a clear-cut look at the nexus between risk and risk management, you need to have a look at an industry that is not forced to do risk management like the banking industry is. Do you have an idea actually which industry research has looked at? Pretty much the gold mining industry. Why? Because gold mining industry and gold mining companies do not have to do risk management, and they pretty much only have one major risk: commodity prices, because they produce gold, they dig up gold, and they are exposed to fluctuations in the gold price and maybe currency risk. So that's why many research articles have looked at the gold mining industry. Now, what do we want to achieve with risk management? In the end, it always has to be maximization or at least stabilization of shareholder value. Otherwise, we wouldn't do it because it comes at a cost. Risk management is a continuous process. It's nothing that can be delegated. It has to be done by central management or at least by someone near central management. So you will probably see risk management consultants, but they will advise a company on how to do risk management, but a company will never fully delegate and outsource risk management, like a call center, for example. Okay. Now let's talk about the risk management process. We'll start with risk identification. So which types of risk do we have? Risk measurement, how large is our exposure to a certain risk type? Risk management, how should we deal with this risk? Then risk control, was it successful? Did we deal efficiently with our risk, or did we suffer some financial losses? And then risk communication. We need to communicate the results of risk management and the strategies available to us to all major internal and external stakeholders. So, in many cases, this is chief management, executives, but it will also be regulators and supervisors for banks. Banks will have to tell central banks or financial supervisors what they have done in risk management, and they will say this is enough, this is sufficient, or this is not sufficient. So this is the risk management process. We'll start with risk identification. We can distinguish between internal and external risk. For example, illegal behavior of employees would be considered an internal risk. There are also external risks that usually will be exogenous. For example, the natural disaster, the earthquake that hit Japan, that's exogenous, and that is something externally that affects the company. We then have to decide which risks are relevant and which could have a significant adverse effect on the company's financial situation. Especially in smaller companies, you will see company risk managers decide on a level of significance. So if, for example, they see that, yes, we have a risk, but it can have a maximum effect of, say, 50,000 euros on our year's result and our yearly income, then the risk manager will maybe say, this is not a significant risk, we'll track it, but we will not do anything about this. It can be significant, and management can still decide that they don't want to deal with this, but this is an important question. So in many cases, risk managers will say, no, we don't care. In some cases, the risk manager will actually say, we should care, but managers will say, no, we don't, and we don't want to do this. I'll give you a very practical example for this. I once heard from a risk manager of an electricity company that they want to build a new plant, let's say a power plant. If you are from Germany, you might know that you will probably have to deal with a lot of environmental laws and regulations before you can even build a normal house, not to say an electricity plant. So the risk manager said that currently there is no need to get an expertise and to get, wie heißt es auf Englisch? Gutachten. An assessment of an external expert, an expert witness, on the question where this plant should be built. So the risk manager said, well, currently no one's asking for this. And the officials say, we will probably not need this. But the risk manager said, well, we could do it anyway, spend, say, 50,000 euros, but we will not risk any delay in construction. The executive said, we don't want to spend that 50,000 euros. Half a year later, well, the officials, the state, or actually the city officials said, now we want this expert witness and we want this, this report on the environmental suitability, etc. So they now have to spend the 50,000 euros anyway, but it will probably delay the whole process by half a year. And the risk manager says, well, told you. So this is something different to this question where the risk manager might already say, we don't have to care, the potential effect on our income statement is so tiny, is so insignificant, we'll just track it, we'll see from time to time whether the exposure has increased, but we don't have to do anything about this. This is usually done in small to medium-sized companies. Because if you're a Deutsche Bank, if you're JP Morgan, yes, you have huge, enormous risk exposure. But many small companies also have risk and are exposed to risk, and they will do risk management. And then you have to at least look at potential risks. For example, if we do have risk management here in the university, so they will look at potential lawsuits, the projector falling down on someone, fires breaking out, and so on and so on. Do they do anything about this? Probably not. Best thing they can do is do regular checkups and maybe buy insurance, but that's about it. But even in a comparatively small company, let's call the university a company, even we have risk management. Many risks are known beforehand. It's not very difficult to think of potential risks, for example, in this lecture hall, but it's sometimes we are making it a little bit easy to ourselves, and we are acting a little bit like Captain Hindsight. Yeah? Well, in hindsight, yes, we should have known, but just take the Fukushima Daiichi catastrophe. Everyone knows Japan suffers from earthquakes. It's a high-risk zone. The whole country is a high-risk zone for earthquakes. And yes, they have nuclear power plants. And yes, the nuclear power plants are built to withstand disastrous earthquakes. Well, but no one thought about the tsunami hitting the nuclear power plant. So it sometimes, in hindsight, it's always easy to say, well, you should have known. But for many cases, risks are not known beforehand. It is one question whether you know risk and you can measure or not measure its risk exposure, but sometimes you do not even know that you have a risk. And no one's sitting below the projector, but maybe you would now think twice before sitting down here, think, okay, now I'm aware of this risk. So this is risk identification. Risk measurement is you need to put a price tag on a risk. For example, if the projector falls down, you will sue for damages, and the maximum amount of money that might come out of a lawsuit is maybe 50,000, 100,000 euros, so that's the potential risk. You could also argue, well, you will probably not be harmed and you cannot sue, but the projector is damaged, so you have a maximum loss of, say, 1,000 euros. You have to put a price tag on each risk, and this can sometimes be very difficult, because what is the potential financial loss of a Japanese nuclear power plant blowing up and having a meltdown? Somewhere in the billions. It's very difficult to put an exact price tag to this. In some cases, it's very simple. If you buy a stock and if you invest $1,000, well, you can lose up to $1,000, so that's your maximum loss. It's a tricky question whether you should simply use the maximum loss as your risk measurement, but we'll come to that later on. In some other cases, it's not, we're not able to measure risk. Also a very practical example. One of Germany's second largest insurer, second largest insurance group, a couple of, probably about 10 years ago now, a couple of years ago they had a huge ad campaign. They had a huge marketing campaign, and they said, we want to do insurance differently. It doesn't have to be as boring as everyone thinks it is. Right at the same time, a scandal broke that this company actually sent off their best salesmen off to a brothel in Budapest. And if you are at the same time having the marketing slogan, doing insurance a little bit different and doing insurance differently, that's a huge reputation disaster. And reputation risk is one type of risk that is very difficult to measure. It is closely related to entrepreneurial risk, but what is the financial loss? You cannot measure it directly. You don't know how high your revenues would have gone if it hadn't been for this reputation scandal. So reputation risk is very hard to measure. Practical example from an energy company. What happens with local energy companies and electricity companies is that from time to time you have a blackout. And if a whole city suddenly has no electricity, that's pretty bad. Hospitals will get problems at some point. Cable cars will stop running, or street cars will stop running. You will realize what I didn't think about is you will run out of gas, because gas stations need electricity for you to pump gas. So at some point, if the blackout stays longer than anticipated, you don't have any electricity and you don't have any gas, so you have to use your bicycle. So that's reputation risk. But on the other hand, it might also be that if you're an electricity company, and these things usually bring out the best in people. If suddenly a town is out of electricity for some time, but people suddenly start to work together, and the company does its best to put on a good PR show, this might actually be good for you, or at least you might be able to dampen the negative effects of reputation risk. But how should we measure it? It's very difficult to come up with a euro figure what a financial loss this could be. In most cases, we'll have to deal with quantitative risk management, statistics, to calculate the risk. If we are not able to do this, if we are not able to use quantitative risk management, we'll use what I would refer to as qualitative risk management. In many cases, it's expert witness and expert judgments that someone says, well, this is a high risk, this is a low risk, and so on. The third step is we have to determine how to deal with the identified and measured risks. First thing is we completely avoid it. Don't make the deal. That's pretty simple. We can try to reduce risk, for example, by entering a hedging contract or by diversifying. We can try to transfer risk. Easiest example is to transfer risk to an insurance company, or we can try to mitigate risk, for example, by setting up a limit system so that one single trader is only allowed to enter contracts up to, say, 50,000 or 500,000 euros. Fourth step is we have to review the identified risks. Were there any new risks that we didn't think about? Did we see this too pessimistically? Sometimes we see some risks that actually aren't there. If necessary, we have to improve our measurement, we have to improve our models, and it must always be checked whether the benefits of the measures taken justify the cost. So if we can actually see that the effect of risk management justifies the costs. And then communicate the results to management, supervisory board, supervisory authorities and regulators, auditors, CPAs, and insurance companies, also actuaries, and everyone who should be interested. And then we get this process, this cycle: identify, measure, control, communicate, and check, and then again try to identify it again. So this is the risk management process. So we'll start with identification and with the main types of risk we have. First, let's distinguish financial risk from real economic risks. Financial risk can be defined as those risks that originate in the investment and financing activities of a company, and thus in its interaction with financial markets. So in particular, financial risk often arise from changes in relevant market prices. But think about everything can be understood as a market price. stock prices, commodity prices, foreign exchange rates, interest rates, and you could even argue that you get a market price for credit risk because you're investing in credit risk and you get a spread for bearing the potential losses due to default. Liquidity as well. So this is financial risk. If you look at the risk report of Deutsche Bank, you will see that they have credit risk, market risk, operational risk, business risk, and diversification benefit. Where to start? With banking, in banking, there's an historical reason why we usually talk about three main types of risk: market, credit, and operational risk. Why? Well, it started in the 2000s with Basel II. You probably know by now from a previous lecture that Basel refers to the Basel Committee on Banking Supervision and Regulation at the BIS. And in Basel II, Basel II, regulators thought it would make sense to standardize regulation in the sense that banks should be forced to deal with at least three main types of risk. Risks from their trading book in market risk, risks that stem from lending business, credit risk, and in effect everything else. And this became known as operational risk. It is the risk of a failure of your IT system, it's the illegal behavior of an employee, it's a natural disaster, it's anything, basically anything related to your operations that is not included in market risk and credit risk. This is operational risk. Actually, I have no clue what they think about what business risk is. One would have to check this. But traditionally, it's just market, credit, and operational risk. They publish this in their annual report. And this is also very, very interesting, because we are now looking at the very core of capital budgeting and capital requirements of banks. Now, internally, we can do the following. We can say that our model bank starts out with 100 million euros in capital. That means that we can actually do business up to 100 million euros. We are a share company, we are a stock company, and what could happen in the worst case? Absent any regulation, we can go bankrupt. When are we bankrupt? When we've depleted all our equity, our capital. So let's assume that we have 100 million in capital. That means that any company should be allowed to do business up to a risk exposure of a maximum of 100 million, right? So, because this is our prerogative as a shareholder, as a manager, we can spend and we can risk our shareholders' investment. We shouldn't go beyond, because then we would be taking risks that actually debt holders have to care about. But we can invest 100 million capital. How should we budget this? A pretty simple idea would be to say, well, we have three departments: credit, market, and let's say everything else. So what we could do is we could say, well, market risk gets 50 million, credit risk gets 25, and operational risk gets also 25. Then we've done our capital budgeting that each department has its own capital to expend and to invest. We should, however, consider that if we do it on a large scale, actually the risk might not be as high due to diversification. So we will have some diversification effects. And this is done here. This is basically the liability side of well, not really the liability side, but this could be the liability side for economic capital. We call this economic capital because it's fictional in a sense, that it's understood as a potential budget we could assign to different business departments, market, credit, and operational risk. This is the internal way of doing this. Then we could argue that, for example, each department has to say, well, we have 50 million or 25 million capital budget, and we want to spend it on this project A and this project B. Project A and project B come at a certain risk, and let's assume project or department A, market risk, has 50 million budget, and they want to invest 50 million in a stock. So they could lose it all, 50 million, they have a budget of 50 million, everything's fine. We could do this for internal capital budgeting. This is what we call economic capital. What happens now is that at some point, financial regulators had the idea of saying, well, we want to use this to guide banks and to make sure that financial institutions and banks are always financially sound. We don't want to risk banks to go bankrupt, so what we do is, first, on the liability side, we have actually very detailed rules and regulations in place that say, for example, how to calculate your capital. We then call it regulatory capital, or just capital in short. If you ever hear capital, it's usually referring to regulatory capital. The tricky thing here is that regulatory capital is not equal to equity. Why? Because regulators accept equity with 100% and some parts of debt also into capital, but not at 100%, maybe at 25 or 50%. Any idea which type of debt they also accept as capital? Non-preferred debt. You might know that debt is not always debt. You have a structure in debt that can be secured, unsecured, preferred, non-preferred, meaning that in the case of default, some debt holders will get their money before others. So if you are the owner of preferred debt, you have preferential treatment in the case of a bankruptcy, in contrast to debt holders of non-preferred debt. And non-preferred debt is closer to equity than preferred debt, and you also have some kind of hybrid financing, for example, convertible bonds. They also count towards capital. This is why on the liability side of a bank balance sheet, you will use several non-equity positions and calculate your capital with it. That's your liability side. And do you know what you have to do on the asset side? You have to calculate the risk exposure. And we then call this the risk-weighted assets. And actually, here you can see that's what the Deutsche Bank is actually doing here. They're calculating their risk position, which means the risk-weighted assets in total. So they have risk-weighted assets of 10 should be billion in credit and 10.4 in market risk, and then this is the balance, the asset side of the balance sheet. What would happen, or what would the regulator now do? In this case, the European Central Bank. They will compare risk-weighted assets with available regulatory capital, and if risk-weighted assets are higher than regulatory capital, what happens? The bank has to increase capital ratio. It has to decrease risk-weighted assets, or it has to increase regulatory capital. So this is this. Okay. What is market price risk? Anything, any risk exposure that comes out, any change of a relevant market price. It could be a stock, it could be a bond, it could be any type of financial investment, financial instrument, but it also is interest rates, foreign exchange rates, commodity prices. And it depends on what kind of company you're looking at. For example, an electricity company will be exposed to market risk stemming from commodity prices, electricity, oil, gas. Whereas a financial institution, a bank, will usually have risk exposure to changes in the market prices of financial instruments. This is again from Deutsche Bank's risk report. The vast majority of our businesses are subject to market risk, defined as the potential for change in the market value of our trading and invested positions. Risk can arise, blah, blah, blah. Interest rates, credit spreads, foreign exchange rates, equity prices, commodity prices, and other relevant parameters such as market volatility and market implied default probabilities. So this is their definition. What do? We aim to accurately measure all types of market risk by a comprehensive set of risk metrics embedding in counting economic and regulatory considerations. Okay. And they have their internally developed key risk metrics. Now, currency risks. What are currency risks? Very simply, if you do business in a foreign currency, you're exposed to FX risk. We call this FX, foreign exchange. For example, if you manufacture a car in Japan and you sell it in Europe or vice versa, you will be exposed to the euro-yen currency rate and currency risk. What could be done about this? Very simply, what are car manufacturers doing? Produce your cars in the country in which you're trying to sell them. So this is why most major car manufacturers have production plants in the European Union or, for example, in the United States. Securities risk. Now, if they are freely traded on a market, they are, of course, subject to market price risk. All securities are subject to this. So not just stocks, but financial derivatives, bonds, certificates, etc. If prices fall, could be a problem. If you have a short position, could be that if prices increase, you have a risk, or generally if prices are volatile. So as a consequence, you will use statistical modeling for coming up with an estimate of volatility and the price fluctuations. And you might also want to use those to forecast future financial losses. Okay. Interest rate risk. Next type of market price risk. Those are the risks that arise from changes to relevant interest rates. The basic prerequisite is that this is an interest-related or interest-bearing product. Otherwise, anything is related and exposed to interest rate risk. So some examples. Loans, interest-bearing securities, and securities whose value is determined by a net present value calculation. And actually, any claim you have. If, for example, you are the perfume store across the street, and if they were to sell products via the internet and you are able to pay your bill in a couple of months, the company has a claim against you. And the company has to work with the net present value of this claim. So if we had interest rates unequal to zero, like we currently have, then of course, even this claim of such an industrial company would be exposed to interest rate risk. And this is important to see and important to remember. You don't have to be a bank and you have some positions outside of lending and outside of loans that are exposed to interest rate risk. Anytime you have to wait for your money, this exposes you to interest rate risk. If these asset positions, if these provide fixed interest payments, and we call those fixed income products, those fluctuating market interest rates also lead to an indirect interest rate risk in the form of opportunity costs. So you have to remember that actually one would think that you would be exposed to interest rate risk if you have variable interest payments. Actually, the opposite is true. Now, variable interest payments and variable interest products would probably pay out 0.1% right at the time, right now. If interest rates change, you will get more, but you would also have to discount your stream of cash flows with a different interest rate. So there will be an increase and a decrease, and the result is that actually you are hedged. The problem arises as soon as you have fixed income products. Because if I were to sell you a bond with a 6% coupon, you would probably think that, wow, risk-free, 6% interest, great. In times of zero interest policy, this is a great investment. But if market rates decrease to 8% on the money market, such an investment would no longer look as interesting as it would right now. So as soon as you have fixed income products, fluctuations in relevant market interest rates expose those products to interest rate risk. So these are the two examples. If, for example, you have given out a loan at a higher interest rate than agreed, in this case, the resale value of this loan changes. So in contrast, if the bank did not sell or assign the loan until maturity, the change in market interest rates would not lead to an immediate loss. But in any case, you will have opportunity costs. You've given, think about this way. Think about those banks that are now forced to give out loans at, say, 0.5%. The problem is that they are investing long-term, just like, for example, insurance companies do. And if they now give out a loan that only pays 0.5%, and if market interest rates were to increase at some point, they would still sit on a lot of loans that only pay out a tiny interest rate. But refinancing costs will probably increase with market rates. So this could be a problem. And second example, that if you have an interest-bearing security, again, prices will reflect fluctuations in relevant market prices and relevant market interest rates. If, on the other hand, you have variable interest payments, like, say, a floating rate note that uses the 3-month Euribor, then fluctuating market interest rates will generally lead to lower price losses. The reason is that you will get higher or lower payments, but you will also have to use a different discount factor. So discounting will counteract the results of the changes in the coupon payments you have, for example, from a floating rate note. That's market price risk. I've left out commodity risk, that's obvious, gold prices, oil, gas, etc. It's very similar to foreign exchange risk. Then let's talk about credit risk. If a company owns receivables from private persons, if it has a claim against a private person, a customer, or another company, the company is exposed to the risk that the debtor defaults on his or her claim. So you will not get your money back. That's basically credit risk. The risk of default is called credit risk. Sometimes it's called default risk. It's sometimes also called counterparty risk. We'll talk about counterparty risk in a different setting later on. It suffices to say that in many types of derivatives contracts, you will be engaging in a contract with a counterparty. This might be another investment bank, this might be an institutional investor. So if the counterparty defaults, you will not have a contract partner in your derivatives contract. And this might be a problem for you. Credit risk is not limited to the realm of banking. Anytime any company has receivables from customers or other companies, you're exposed to credit risk. My best example for this is a large electricity company. If you are an electricity company, you will be exposed to credit risk. When and why? Actually, we can distinguish two types of credit risk those companies will be exposed to. First type is regular credit risk in its retail electricity business. Why? If you don't pay your electricity bill, you default on your debt to the electricity company and the company loses money. Credit risk management in this context is actually quite simple, at least in Germany. Do you know why? Because if you fail to pay your bills for 3 months, they will simply shut off electricity. So what is the average electricity bill? Let's say 100 euros per month. So the maximum exposure per client, per customer, is usually assumed to be somewhere between 200, 300 or 400 euros. Because after 3 months, electricity will no longer be delivered and your losses are limited to this amount. But most electricity companies also have counterparty risk. Do you know how and where and why? It has to do with something that is very close to us geographically. Unfortunately, we cannot see it out of this window. If the window would be, if we were to step out the lecture hall, you would immediately see the reason why. The EEX, the European Energy Exchange. Why? Why is counterparty risk important? Does anyone know how the electricity market works? In short, companies, electricity companies, produce electricity long term. They have to calculate the needed electricity input and output mid and long term. They have to send this information to a regulator, basically to a net regulatory authority, and then they sell electricity on the other side of their business that is completely separated from production. They sell electricity to their customers. So if, for example, they do bad forecasting and they sell more electricity than they had anticipated, the net might not be in equilibrium. And the net authority, the net supervisor, has to make sure that electricity nets are always in equilibrium, because otherwise the net will blow up. That's quite clear. Or you will have a blackout. So what happens is, the electricity company, if they have sudden spikes in supply or demand, they will have to buy electricity or sell electricity on the spot market. The spot market being the European Energy Exchange here at Leipzig. And what they do is they will engage in energy and electricity trading. And they will engage in trading with trading houses. We actually have a couple of trading houses, very small companies here at Leipzig, that have specialized on the spot market trading. So they will buy and sell electricity on the spot market. And if one of these counterparties, they default, and usually these trades take place in an OTC market, if those counterparties default, well, the energy company, the electricity company, suddenly has to look for someone else to buy or sell electricity on the spot market from. And this can be very extremely costly. Ich erzähle das nochmal kurz auf Deutsch, damit Sie das einmal verstanden haben, wie der Elektrizitätsmarkt funktioniert. Es ist relativ einfach. Sie haben letztlich einen Bilanzkreismanagement, so nennt sich das. Es gibt Bilanzkreise, sie müssen zugelassen werden. Nicht jeder kann seinen eigenen Strom produzieren. Und im Bilanzkreismanagement läuft es letztlich so, die Netzagentur und die Bilanzkreismanager müssen natürlich sicherstellen, dass jederzeit das Stromnetz funktioniert. Dass das, was reingeht, auch rausgeht, dass die Leitungen nicht plötzlich überlastet werden und dass wir keinen Stromausfall haben. Und wie wird das sichergestellt? Sie haben einen Bilanzkreislauf. Jeder Stromhersteller und jedes Energieversorgungsunternehmen muss jederzeit sicherstellen, dass sein Bilanzkreis ausgeglichen ist. Heißt, das, was reingeht, muss auch rausgehen, beziehungsweise das, was rausgeht, muss notfalls eingekauft werden. Und wenn es eine Überproduktion gibt, weil das Atomkraftwerk gerade gut läuft oder vielleicht eher die Windkraftanlagen, da ist das ja gerade kritisch, dann muss diese überschüssige Elektrizität verkauft werden. Und das tun sie am Spotmarkt, an der EEX. Und das ist dann der Energiehandel. Da handeln sie nicht langfristig, das machen sie nicht. Ja? Sie kaufen nicht langfristig ein, also in den seltensten Fällen. Das, was sie dort machen, ist, sie verkaufen überschüssige Elektrizität oder sie kaufen das kurzfristig ein, damit das Netz ausgeglichen ist. Ja? Fiktiv, das ist natürlich, wie der Name schon andeutet, eher eine bilanzielle und eine kalkulatorische Rechnung, die sie da aufmachen. Und das, was sie dann tun, ist, sie müssen an dem Handel, häufig machen sie das mit irgendwelchen Handelshäusern, mit kleinen Firmen. Hier in Leipzig gibt es ja einige, die das machen. Das sind teilweise 15-Mann-Betriebe. Und da gibt es sehr viele Beispiele, dass, wenn die schlecht handeln, dass sie dann auch von heute auf morgen pleite gehen können. Das Problem ist nicht, dass dann sie eventuell ihr Geld versenkt haben. Das kann natürlich auch passieren. Das Problem besteht dann darin, dass sie eigentlich eingekauft oder verkauft haben mit diesem Handelspartner. Wenn er pleite geht und als Gegenpartei ausfällt, müssen sie noch teurer einkaufen oder verkaufen. Es kann ihnen passieren, das ist eben das Problem, dass sie kurzfristig tatsächlich Elektrizität verkaufen zu einem negativen Preis. Weil wenn das Netz voll ist, und sie haben trotzdem Strom und müssen das abgeben, dann kann der Preis auch negativ werden, weil sie dann natürlich dafür bestraft werden, dass sie letztlich dazu führen, dass irgendwo anders Strom sinnloserweise rausgenommen werden muss. Also das ist grob die Funktionsweise des Strommarktes und deswegen, da ist gerade im Energiehandel das Gegenparteirisiko ein alltägliches Problem, weil sie handeln dann nicht immer nur mit E.ON und RWE, sondern auch teilweise mit sehr kleinen Firmen. Nebenbei, Sie können sich ja mal anschauen, ich sage Ihnen nach der Aufzeichnung mal so ein paar Namen. Es gibt ja einige Energiehäuser oder Handelshäuser, die machen nichts anderes als einfach nur den ganzen Tag eben genau das, Spot Trading, teilweise auch Algorithmic Trading. Und das sind Läden mit 15, 20 Mann, die machen Millionen pro Jahr. Also gibt es einige, die haben innerhalb von 5 Jahren haben die sich hier zum Millionär gemausert, weil man da, wenn man das Business versteht, wenn man auch ein bisschen Ahnung von Finanzmathematik hat, da können Sie relativ schnell gut Geld machen, aber es ist natürlich auch ein High-Risk-Taking, was Sie da machen. That's counterparty risk for you. We can distinguish 2 types of credit risk, basically. First one is credit risk in the strict sense, meaning that every time you just look at default, no default, this is credit risk in the strict sense. It's a binary decision variable, you're default or you're not. Credit risk in the broader sense is the probability that you might go bankrupt. And this is not a binary variable, it is rather later on probably a score value or a rating. So you might have a AAA rating or a AA, triple B, double B, D, and so on. So this is credit risk in the broader sense, actually broader with OA. That's a typo here. Why? Why do we make this distinction? In some cases, we don't care about the probability. Well, we do care about the probability, but it doesn't make sense to think about a deterioration in the default probability. Remember this example for retail customers in an electricity company. We care about the default probability, but we don't actually work with this. We only say there's a 20% probability he'll go default, and if he goes default, if he goes bankrupt, yes, everything's lost. Now, the larger our counterparty gets, it makes sense to look at a rating. For example, if we were to deal with Apple, it makes sense to incorporate information in pricing to say, for example, if Apple has a AAA rating, we'll charge 2%. If it only has a AA rating, we'll increase our price to, say, 3%. And if it only has a BBB rating, we'll increase our price to 8%. Then we'll include this additional information about the continuum of default probabilities into our pricing. We wouldn't do this here with a €200 electricity bill. No one does that. But it makes sense in this case. In the example of those energy trading houses, actually, yes, even for small counterparties, the risk managers use ratings. Do you have any idea how they use those ratings in risk management? they use those in a limit system. They will say, for example, I'm making up the figures, but it's basically this idea, that, for example, if you are a large energy company, say you are E.ON, and you're trading with a small trading house, could be that if the trading house, the trading partner, has a AAA rating, your trading floor is allowed to do business up to 5 million with this partner. If it only has a AA rating, the limit system tells traders the maximum risk exposure is, say, 4 million. If it only has a BBB rating, we will not accept any business with this company. So the rating actually is not included in the pricing, but in a limit system to limit your risk exposure when it comes to counterparty risk. Well, that's counterparty risk. I think in this example, for an energy company, this is very intuitive. Counterparty risk became hugely famous during the financial crisis. Any idea when and how? CDS. With CDS contracts, CDS are OTC traded. Anything that is traded over the counter, OTC, so not over an exchange, is exposed to counterparty risk as long as you don't have a central counterparty where clearing is done and payments are guaranteed. So in the basic form of an OTC traded CDS contract, credit default swap. Let's make this example using the example used in The Big Short. I'm Christian Bale. I'm the fund manager for an investment fund, and you're JP Morgan. I want to buy credit default insurance against the default of certain funds, of certain investment vehicles, of certain securities. And I say, I want $100 million protection against the default of, say, you're looking at me, you're a security portfolio. So the deal is, we make a 5-year CDS contract. If anything defaults in your product, or if you are, let's say you're Deutsche Bank, I'm buying credit default insurance against Deutsche Bank. If you default within the next 5 years, I will be getting $100 million from you, JP Morgan. And you, as a quant, will tell me, well, notional 100 million, you will have to pay 5% premium on that. So every year, for these 5 years, I will have to pay $5 million in premiums to you for this credit default insurance. What is the difference to a regular default insurance with an insurance company? Well, we can enter this contract without Deutsche Bank ever knowing. And I don't have to have any kind of exposure towards this entity. We can enter this contract on our own. An insurance company would never insure something you're not exposed to, right? That's a credit default swap. That's actually a 5-year credit default swap, plain vanilla credit default swap with a 5% CDS spread. It's a spread that I have to pay in order to get the contingent payment of 100 million. I could also say, I want to buy 200 million. And you will see a lot of problems attached to this. You immediately see the empty creditor problem coming out of this. I could actually speculate against Deutsche Bank. And if I have a small loan given out to Deutsche Bank, I could try to use this loan to force Deutsche Bank into default, into bankruptcy, and exploit my investment in the credit default swap. Next problem is that JP Morgan, if you have a problem, if you go bankrupt, my CDS is worthless. And during the financial crisis, actually people realized that one counterparty was the main dominant player in this market, AIG. So I had bought CDS from AIG, you had bought credit default swaps from AIG, and so on and so on. And in the end, people started to realize that if AIG had gone bankrupt, every investment bank would have had no insurance against the default of other instruments and other companies, and this would have worsened the financial crisis. This is why the Fed bailed out AIG, American International Group. So this is counterparty risk. in the context of CDS contracts. It's an OTC contract, so if your counterparty defaults, your OTC traded derivative is worthless. Some varieties: replacement risk, issuer risk, performance risk, country risk, but this is not so interesting, I think. I told you about this. It is very relevant in OTC trading, and nowadays regulators are trying to curtail this risk by introducing a central counterparty for clearing, meaning that you're actually trying to turn an OTC market into the direction of an exchange-traded market, where you have clearing and central services with a central counterparty. What is clearing? The entire process of actually settling a financial transaction. Everyone needs to know where to send the money, how much money, and this is called clearing. And in OTC trading with central counterparties, market participants do not enter into transactions directly, but always indirectly via the central counterparty. So this example of AIG should be clear. US to take over AIG in 85 billion bailouts, central banks inject cash as credit dries up. And on the next slide you can see AIG, this is from the Wall Street Journal, AIG was a major seller of credit default swaps, essentially insurance against default on assets tied to corporate debt. And AIG's millions of insurance policyholders appear to be considerably less at risk. Actually, this is what insurance economists at that time always argued. It wasn't the insurance business that caused AIG to fall. It was the fact that AIG had ceased to work as an insurance company and had become a major trading house and trading corporation. Okay. Credit risk in practice, again, here from the report of the DZ Bank Group. It's the head institute of German cooperative banks, DZ Bank. And again, you can see traditional lending, securities lending, derivatives, and so on. And this is where they've spent their money. This is how they are invested in firm, mostly firm loans. Okay. Then, next to credit risk, we also have liquidity risk. So all those risks we've seen actually only have an indirect effect on the financial well-being of a company. You will lose money, that's okay, but companies lose money all the time. The main problem we might have is bankruptcy, is insolvency. And when do we have to file for bankruptcy? When we run out of cash and cash equivalents. So actually, liquidity risk is the main reason we have, or the main risk we have to deal with first, because everything at some point will turn into liquidity problems. If we lose money, we run out of cash. If we suddenly have to pay out loans, we run out of cash. We have short-term liabilities. If our asset value is reduced, if our security holdings suddenly become worthless, well, we might have some cash, but we don't have any reserves. We might deplete in case we run out of cash. So in the end, it's always about liquidity. And you need to manage liquidity, and it is just the inability to be able to meet your short-term liabilities and your short-term payment obligations. Could be two things. Could be a sudden decrease in liquidity, and it could be a sudden increase in short-term obligations. Yes. And there could actually be good reasons why you run out of liquidity. Think of a bank. Can you give me an example why the bank could suddenly run out of liquidity for good reasons? Or an industrial company could happen the same. Imagine you've given out credit lines, lines of credit to your customers. And suddenly all your business customers, your firm clients, your corporate clients, they need new loans because they want to invest. Then this is new business for you. And actually those lines of credit come at a high price, and they will earn you interest. So actually you are suddenly investing a lot and you've given out those lines of credit, and new business is actually quite nice. Problem is that if you don't have the available cash and the available liquidity to satisfy those needs, you might face bankruptcy. This is the liquidity of a company. The company's ability to meet its short-term payment obligations. It's related to the liquidity of an asset. What is the liquidity of an asset? In English, a very nice definition, the ease with which you can convert any asset into liquidity. And more generally, the ease with which you can buy or sell a given asset. Die Leichtigkeit, mit der Sie einen Vermögensgegenstand kaufen oder verkaufen können. This also means that it's not just about pricing. It's not just about the price. It's sometimes also about speed. I might be able to sell my smartphone for a pretty good price, but maybe not immediately. If I take out a 20 euro bill, who would give me 20 euros for my 20 euro bill? Well, it's trivial. Obviously, anyone, I could simply say, I will give you a $20 note or 20 euro note for €19.99 for a small haircut. And each and every one of you would immediately say, well, here is €19.99. But with a smartphone, I might be able to get a similar pretty good price, but the problem is I have to wait. I have to look for a contract partner, and I will have search costs. So this is a second dimension of liquidity. It's the ease with which you can buy or sell an asset. So it could be a bad price, or it could be that you have to wait until you get a good price. Then, if you run out of cash, you're insolvent. If you're insolvent, you have to file for bankruptcy. And if you don't do this, you might even be liable to criminal prosecution. Because in many countries, same in German, it's a criminal offense to delay the filing of bankruptcy. Das ist Insolvenzverschleppung. Damit sind sie strafrechtlich dann auch belangbar. Liquidity risk is the risk that a company has insufficient liquid funds to settle all short-term liabilities. So it can rise in two ways. Liquidity goes down, short-term obligations go up, as in the case, for example, that you have new business coming in. Could also be refinancing risk, that, well, actually you have liquidity, but you have to repay a bond, and you have an extreme need for liquidity. So for repayment of a bond investment, of an issued bond, you need more financing. So this could be a problem. It is of extreme and uttermost importance for banks. Why? Because banks are in the business of transforming maturities. Banks always finance short-term, invest long-term. So by definition and by construction, they are always exposed to liquidity risk. And way before we had any large, efficient liquid stock exchanges or financial derivatives, hundreds and hundreds of years ago, banks and financial economists were concerned about the risk of a bank run. What is a bank run? We've not seen this, we'll see this later on. A bank run is a situation where you think as a customer that you might lose your deposits, so you run to your bank, you demand repayment, and because everyone's doing this, you are actually completing and fulfilling a self-fulfilling prophecy. You only have to think that your bank is in danger of default. So you run, because if you're late, you will get nothing. First come, first serve, so you might be the lucky one who still gets some deposits back. So you run. The next person sees this, he or she also runs. Everyone runs, and all those running depositors actually cause the bank to default. And then you're fulfilling your own prophecy that you're causing the problem you're aware of. That is a bank run. Das ist ein Schaltersturm oder ein Bankensturm, Schaltersturm. And this is a central research field in financial intermediation and banking, and also one of the main reasons for regulating banks. Because banks, we say that banks have, by construction, a fragile funding structure. Its financing structure is always fragile because you have deposits. Now, for insurance companies, liquidity risk usually plays a rather insignificant role because you have a relatively constant inflow of premiums, and massive withdrawals of cash are rather infrequent. You don't have what we call an insurance run. That is very highly unlikely. It has happened before, but not with any significant results. However, this doesn't mean that liquidity management, and actually this is called asset liability management in insurance, that this is not important to insurance companies, but it is important for another reason. They are doing it to maximize profits, and they don't really need it to make sure that they survive all the time, just like banks do. So this is liquidity risk. Last but not least, let's talk about operational risk. All types of risk we've talked so far have in common that usually it's an exogenous risk. A natural catastrophe, interest rates change, currency rates change, someone else defaults, etc. However, losses can also arise from exogenous events that do not belong to the core business of the company. For example, IT system fails, or a trader engages in rogue trading, or it could be an endogenous source of risk, own employees, internal processes, etc. This is maybe a little bit misleading. I call this endogenous in the sense that this is an internal type of risk. Internal managers, internal employees, internal processes. However, if you're interested in a more philosophical but also very practical assessment of this, you should look at the papers by Jon Danielsson from the London School of Economics. He has done some research on endogenous risk, and endogenous risk is actually understood as, in this sense, that is risk that arises from risk management. It is created by your own efforts to counter risk. And I can give you two examples for this. The first example is the London Millennium Bridge. The London Millennium Bridge is a pedestrian bridge that was open for the millennium, and it was constructed to withstand strong winds on the Thames. And actually they thought about, engineers thought about how the bridge should react to wind and movement of people. Problem is that people started to move when the wind became stronger, but they didn't do it randomly. But everyone started to move and to counteract the movement of the wind and the bridge in a synchronized way. And the synchronized way of people moving and standing on the bridge caused the bridge to become highly unstable. They had to close it down after a couple of weeks and do some repairs and some modifications to the bridge. And this is one of his examples for endogenous risk. Why? Because actually the risk that the bridge becomes unstable is actually caused by people trying to counter its own instability. But because the way they are doing it causes the risk to become larger. This is endogenous risk. Second very good example is mentioned in a research paper in the, I think, Review of Financial Studies by Suleiman Bazak from London Business School on valued risk, risk management. We'll talk about valued risk later in the next session. Valued risk is a risk metric, and he argues that actually the way regulators have forced banks to all use the same risk metric has actually made the banking sector more unstable, because if everyone does the same, the system suddenly becomes very homogeneous and it becomes very exposed to the same type of hit. Basically, this is his argument. And you can argue the same actually for fair value accounting during the financial crisis. Also, the fact that all large banks used fair value accounting actually caused all banks to do large write-offs on their asset portfolios. So this is risk before. Now we want to talk about endogenous internal risks and exogenous events that are outside of our core business, lending, securities trading, etc. So with Basel II regulation, regulators argued that we need a third type of risk, the bucket for the remaining risk types, that captures all this. And this was adopted, for example, in the solvency regulation in Germany, in paragraph 269 of the German Solvabilitätsverordnung. And it says, this is translation, operational risk is the possibility of losses arising from inadequate or failing internal procedures and systems, people, or from external events. This definition also includes legal risk. So it's basically everything else than credit and market risk. System failure, IT failure, fires, natural disasters, floods, people stealing from us, and legal risks. External events can be anything. And this is op risk. This is operational risk. Careful. For insurance companies, it's slightly different. For example, here, on the Solvency II, the German group of insurers, the GDV, specifies this operational risk under Solvency II from the view of the German insurance business. That's not the regulator's view. They argue it's reputational risk, risk from strategic decisions, as well as actively taking risks out of insurance products. They do not belong to operational risk. Now we can argue whether we should include reputation risk, legal risk to operational risk or not, but this is basically a question of definitions. The nice thing with Basel II and Solvency II regulation is that it now has a name. Before that, banks always had these risks as well, but they never called them operational risks. But now you have a name for this, and operational risks are characterized by high level of losses, very low likelihood of happening. The Daiichi Fukushima earthquake and tsunami is a good example. Very difficult to measure, highly unlikely. It's one event in a century maybe, and as a result, it's very difficult to measure. This is what makes op risk management very difficult. And again, the case of Barings Bank, natural disaster, insufficient internal processes, rogue trader, you have everything coming together in the case of Barings Bank. Okay, any questions concerning risk types, op risk, credit risk, etc.? So if you don't have any questions, we'll stop here and continue with risk management and risk measurement next year. So nice holidays and a good New Year's Eve and good start in 2020, and see you next year. Thank you.